Welcome to the weekly market read on the Great Rotation. We are observing capital fleeing abstract growth for tangible assets amidst a violent subsurface churn. The chart illustrates a sector rotation in relation to the S&P 500, indicating a neutral to bearish sentiment. The current environment is characterized as stagflation light meets sector violence. Bearish drag is fueled by stagflationary friction, with high core PCE and slowing GDP as the Fed maintains a, quote, higher for longer policy. This pushes capital out of long-duration tech and into small caps and industrials, which are showing a bullish floor with strong cyclical rotation and a flight to real assets. We are seeing a divergence between cap-weighted stagnation and equal-weight accumulation, resulting in the widest performance gap since 1992. Cap-weighted indices like SPY and QQQ are struggling, showing negative real returns due to AI investment fatigue. In contrast, equal-weighted and small-cap indices, RSP and IWM, are accumulating and hitting record highs. The narrative is shifting from algorithms to amperes. Phase 1, the software hype, is experiencing liquidation. The market is moving toward Phase 2, infrastructure, focused on return on invested capital in sectors like utilities, industrials, and commodities. This shift is driven by global power demand projections and a significant valuation gap. The current risk regime is defined by volatility as a floor and geopolitics as a ceiling. The volatility index spiked on macro data. Geopolitical risk from the Middle East and Iran creates an artificial price floor for energy. The option signal suggests a two-way risk, indicating high hedging activity and a lack of directional consensus. The sector leaderboard for the week shows utilities, industrials, and energy leading the gains. These are driven by AI power play, grid/CapEx, and geopolitics, respectively. At the bottom, infotech, consumer discretionary, and financials are lagging due to outflows, spending fatigue, and yield curve drag. The leaders represent the physical world striking back. Utilities are transforming into AI growth assets, driven by data center baseload demand. Industrials benefit from core durable goods orders, driven by onshoring and grid modernization. Energy has a dual-pronged bid: Middle East tension and AI needs for backup gas/nuclear. The laggards are facing valuation compression and consumer stress. Infotech shows a broken technical trend and weekly outflows. Consumer discretionary faces a toxic combination of low savings rates and high credit card rates. Financials are caught in a value trap due to yield curve inversion and increasing default risks. Communication services is an anomaly that survives the rotation. Unlike hardware tech, XLC is monetizing AI now through AI-driven ad targeting, leading to higher ROI for advertisers. This results in strong earnings revisions and margin protection, with Meta and Google as representative tickers. Our first tactical opportunity is the Industrial Renaissance, XLI. The thesis is that grid modernization is non-discretionary, re-rating old economy stocks as growth. Validation comes from sustained inflows to XLI and grid ETF. Potential invalidation would be the 10-year yield, breaking above 4.50%. Tactical opportunity number 2 is the AI Power Nexus, covering XLE and XLU. Hyperscalers need gigawatt-scale power 24/7, making utilities the new landlords. Validation includes tech giants signing long-term power purchase agreements. Invalidation would be WTI crude collapsing below $57. Tactical opportunity number 3 focuses on specialized growth, XLC. The thesis is mean reversion in specialized cloud and ad tech, buying the monetization layer. Robust earnings from the digital ad duopoly validate this. Invalidation would be a drop in LEI bleeding into corporate ad budgets. The defensive shield centers on yields and dividends. The 4.07% risk-free rate enforces equity yield discipline. Dividend ETFs are outperforming. In a stagflation-light environment, dividend compounding is the primary engine of total return, as highlighted by comparative yield and strength. The upcoming earnings crucible for the week of February 23, 2026 is critical. Wednesday's NVIDIA event is the kingmaker. It will either validate capital expenditure and confirm a bullish outlook for industrials and utilities, or confirm fatigue, which would be bearish for the broader market. Our hedge strategy addresses geopolitics and fiat debasement. Capital flows show large outflows from SPY and inflows to gold, indicating a flight to safety and capital hiding. Hard assets like gold and domestic infrastructure are a necessary shield against inflationary spirals and potential yield curve loss of control. Our final posture is selective aggression. Maintain a neutral index bias, but be aggressive in old economy sectors like grid, power, and industry. Wait for earnings proof on mega-cap tech due to high PE risk. Monitor the 10-year yield. Tightening stops if it rises above 4.07%. The market is rebuilding the physical world.